The market's confession. When illusions unravel, you feel the tremor, don't you? That subtle shift in the air when the market, for a moment, remembers its true nature, stripping away the layers of expectation and revealing the raw nerves beneath. Today, we observe not a mere price correction, but a profound confession from a system grappling with its own contradictions, a system where the pursuit of safety often leads to the very risks it seeks to avoid. The world watches as the familiar anchors of the financial system begin to drag, pulling down even those assets once hailed as the new frontier. Bitcoin, the very embodiment of a different path, finds its price momentarily entangled in the panic, a reflection of the human tendency to categorize the unknown alongside the known. But we must ask, is this a failure of Bitcoin, or merely a stark illumination of the systemic fragility it was designed to transcend? Let us look closer, beyond the numbers, into the human actions that sculpt these market movements. We begin with the illusion of control, the persistent belief that the future can be managed, that economic outcomes can be engineered. You see it in the data, don't you? Well, the producer price index, a number meant to quantify the cost of goods at their source, rises hotter than expected. For those who cling to the narrative of cooling inflation, this is a jolt, a disruption to a carefully constructed story. But what is inflation, truly? It is not merely a rise in prices. It is the devaluation of the monetary unit, a consequence of credit expansion, of money created without a corresponding increase in real wealth. It is a hidden tax, silently eroding the purchasing power of your labor, your savings, your future. When the PPI surprises, it is not the market misbehaving. It is the market revealing the truth that was always there, obscured by the very mechanisms designed to smooth over economic reality. The central planners, in their infinite wisdom, attempt to guide the economy, to stimulate, to stabilize. But every intervention, every manipulation of the interest rate, every expansion of the money supply distorts the delicate signals of the market. It misallocates capital, encourages malinvestment, and ultimately breeds the very instability it purports to prevent. The hot PI is not an anomaly. It is a symptom of a deeper chronic condition. It is the market whispering, then shouting, that the emperor has no clothes. Then, we turn to the credit markets, the very arteries of the modern financial system. We observe credit spreads widening, reaching levels not seen in months. What does this signify? It is the market's assessment of risk, a collective judgment on the solvency and stability of borrowers. When spreads widen, it means lenders demand a greater premium for the uncertainty they face. It is a loss of trust, a quiet acknowledgement that the promises made might be harder to keep. Private equity firms, those titans of leveraged finance, see their valuations plunge. This is not just a dip in stock prices, it is the unwinding of assumptions, the reevaluation of risk that was once deemed acceptable. For years, cheap money, born from central bank policies, fueled an era of easy credit, allowing companies to borrow extensively, to acquire, to expand, often without the underlying productivity to justify such ventures. Now, as the cost of capital begins to reflect a more honest reality, the edifice built on borrowed time and borrowed money begins to sway. The widening credit spreads are not merely a technical indicator. They are the market's confession of past excesses, a reckoning for the illusion of endless growth fueled by artificial means. Do you see the pattern now? The market is not merely reacting, it is confessing. And as if the economic tremors were not enough, the geopolitical landscape adds its own layer of uncertainty. Tension between nations, the evacuation of embassy staff, the rising odds of conflict, these are not isolated incidents. They are expressions of human action on a grand scale, driven by competing interests, by the pursuit of power, by the very scarcity of resources and influence that defines our world. In such moments, the flight to perceived safety accelerates. Gold, that ancient store of value, surges. Silver, its industrial cousin, follows suit. Crude oil, the lifeblood of global commerce, jumps. These are not irrational movements. They are rational responses to perceived threats, a collective scramble for tangible assets when the abstract promises of paper money and digital ledgers feel less secure. But what kind of safety do these offer? Gold, while a historical hedge against monetary debasement, remains a physical asset, subject to confiscation, difficult to transport, and reliant on centralized storage. Oil, a vital commodity, is inherently volatile, tied to geopolitical whims and industrial demand. They offer a temporary reprieve, perhaps, but not a fundamental solution to the systemic risks that plague our world. And what of Bitcoin in this maelstrom? We observe its price falling back, erasing recent gains, moving in tandem with broader equity markets and risk assets. For many, this is a disappointment, a betrayal of its promise as a safe haven. But we must understand the context. Bitcoin, for all its revolutionary potential, still exists within a world dominated by legacy financial paradigms. It is traded on exchanges that are often intertwined with traditional finance, influenced by the same algorithms and human biases that govern other markets. When panic grips the broader market, when liquidity is sought, even Bitcoin can be sold to cover losses elsewhere, or simply because it is still perceived by many as just another risky asset. This is the market's initial, often misguided, classification. It is the human tendency to fit the new into old categories, to judge the future by the metrics of the past. But this temporary correlation, this momentary entanglement, does not diminish Bitcoin's fundamental truth. Bitcoin is not merely an asset. It is a paradigm shift. It is the only true digital scarcity, a monetary system built on mathematical proof, not on the whims of central banks or the decrees of government. It is individual sovereignty, decentralized knowledge, and sound money. It is the antithesis of credit expansion, the antidote to monetary illusion. While other cryptocurrencies, the altcoins and memcoins, rise and fall with the speculative tides, often mimicking the very centralized structures they claim to oppose, Bitcoin stands apart. Ether, XRP, Solana. These may offer technological innovation, but they often compromise on the core principles of decentralization and absolute scarcity that define Bitcoin. They are part of the noise, the attempts to replicate or centralize what Bitcoin made truly free. Even stablecoins, while offering a bridge to the legacy system, are ultimately tethered to the very fiat currencies whose instability Bitcoin seeks to escape. They are a temporary convenience, not a lasting solution. The companies built around this nascent digital economy, MicroStrategy, Coinbase, the miners like Iron, and Core Scientific, they too feel the pull of the broader market. Their stock prices fluctuate, reflecting the prevailing sentiment. This is natural. They operate within the existing legal and financial frameworks, and their valuations are subject to the same forces that affect other publicly traded companies. Their connection to Bitcoin is a strength, but their integration into the legacy system means they cannot be entirely immune to its contagion. Yet, even here, we see a deeper truth. The miners, increasingly linked to AI infrastructure, are not just speculative ventures. They are the guardians of the network, the physical manifestation of Bitcoin's security. Their work is fundamental, not merely transactional. So, when a director from a trading firm suggests that Bitcoin's upside looks capped, that prices will remain range-bound, or that March is historically a weaker month for crypto majors, we listen, but we interpret. These are observations from within the existing framework, predictions based on historical patterns and speculative positioning. But Blocksonic does not predict the market. We read its memory. We understand that these are the echoes of human action, the collective biases and fears expressed through price. The options expiry, the support levels. These are artifacts of a speculative gain, not reflections of Bitcoin's enduring value proposition. The risk-off mood is not a cause. It is a symptom of a system that has accumulated too much risk, that has stretched its credit too thin, that has printed too much money. Perhaps then, this moment of market turbulence is not a setback for Bitcoin, but a profound opportunity for clarity. It is a chance to distinguish between the noise and the signal, between the temporary fluctuations of price and the immutable principles of sound money. It is a reminder that true financial freedom is not found in chasing speculative gains within a broken system, but in opting out of that system entirely, in embracing a monetary paradigm built on scarcity, transparency, and individual sovereignty. The question isn't what Bitcoin is worth today, in the fleeting moment of market panic. The question is, what is the cost of ignoring the truth it reveals, day after day, tremor after tremor? What is the true value of a system that offers an escape from the very risks that now plague the world? We are block sonic. We don't predict the market. We read its memory. Never forget, Bitcoin is only yours in your cold wallet.